Hello everyone. Today we are going to talk about why we prefer capital goods space, and as we have been saying at Edelweiss Mutual Fund, we currently hold a positive view when it comes to the capital goods sector. In general, capital goods sector comprises of businesses such as industrial Capex and engineering product companies that are leading IoT or automation adoption. Another space like defense is where we hold a positive bias. Now if I talk about why we are positive on capital goods space per se. If you look at the India's macro stand, it's head and above shoulders when you compare on both absolute and relative term compared to all major economies around the world. This along with the few of the components or the parameters like we foresee there is an improved current account deficit, policy and political stability, a peaking global monetary tightening cycle, and above all the exceptional profitability which has been shown by corporate India are few of the factors which makes us positive. Just a case in point, reflecting upon the sentiment which we have talked about in terms of the profitability improvement, the BSE 500 companies have shown their profitability improve from almost 4 trillion INR, which was the case in point in 2014, to almost 10 trillion INR in 2023. This obviously bodes well as a precursor to the Capex cycle. Now if we talk about what are the positive triggers which are making us positive on the capital goods space from a near to mid-term perspective. The first component, there are various reasons which makes us positive. I'll enumerate few of them right here. The first is recovery of the industrial Capex, which will be led by the continuous spending by government and PSU entities. The second point is private sector Capex, where you have seen the corporate balance sheet having been delevered and the capacity utilization factor also, which is hitting almost mid-cycle highs, and that will lead to intent on the spends. Case in point again, if you look at the private Capex announcement so far which was seen in FY23, there is almost a threefold increase there, and that's translating into almost 16 trillion INR as we speak. Another factor which makes us positive is the automation and the IoT, which is leading to a need for shop floor overall and hence creating opportunity when it comes to the capital goods and the engineering place. Incremental opportunity which is backed by digitalization drive like data center, 5G spends can lead to billions of dollars of opportunity when it comes to creation of physical hard infrastructure. If you look at the reference point, we are looking at possibly $5 billion kind of a Capex opportunity within this space itself over next 5 to 7 years. Another factor which makes us positive is the indigenization of defense Capex. Defense in our understanding could be a multi-decadal theme which has just started to flourish. India's defense spend, if you look at as a percentage of GDP, has more than doubled to almost 3.3% by FY24 on our expectations versus 1.6% what we saw in FY19. Add to that a factor for the domestic players is, if you look at the domestic procurement as a percentage of the overall defense Capex budget, it has moved to almost 75% in current fiscal from about 68% in 23 and from 64.4% in FY22. Lastly, with another factor, and which is where we again see a more long-term multi-decadal theme, is the initiatives like the production linked incentive scheme, which can give boost to both India's employment creation opportunity as well as expanding the market share of manufacturing sector as a percentage of India's GDP, which is that movement looks at almost like a 16 to 17%. Our back of the envelope calculation suggests that the Capex commitment so far under the PLI scheme is almost 4.5 lakh crore rupees. If you talk about government incentives, we are looking at 2.5 lakh crores of government incentives around that. New job creation opportunity of almost 4 million youth. Add to that a possible revenue creation opportunity which could be upwards of 125 billion INR. All this sum total clearly gives you a strong runway from a medium term perspective when it comes to backing the PLI incentives. Now I'm going to talk about valuations. Clearly, I think when you talk about valuation in isolation, it never gives you an absolute picture. The Indian industrial sector has clearly experienced a notable re-rating in the past few years due to expectation of Indian Capex recovery. A pointer in case here, if you look at the overall Capex spend, it has grown by almost 18% in last 2 years for the Indian listed companies versus merely 7% CAGR which was seen in last 5 years and a mere 5% CAGR in last 10 years. Another point is we believe beyond the domestic recovery, there is also an export opportunity which can give Indian Capex incentive businesses a huge opportunity given we enjoy twin benefit of engineering talent as well as one of the lowest cost of delivery. If I look at the rising capex intensity, it bodes well overall for the industrial and capex companies. As such, we believe the scope for earning-led returns itself can be a great enabler to stay invested in this sector, even if one takes a cautious view for the further multiple re-rating, given the benefit of re-rating we have seen over the last few years. I think this kind of encapsulates our view on the overall capex and the capital goods sector. Happy investing. Thanks for your time.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.